Investing in the stock market. Your top 5 options. Welcome to the Money Game channel. Today we're diving into the top 5 ways you can invest in the stock market. Whether you're a beginner or looking to diversify your portfolio, these strategies will help you make informed decisions. Investing in the stock market can seem like navigating a maze, but it doesn't have to be that way. We'll break down each strategy, highlighting the pros and cons, so you can choose the best fit for your financial goals and risk tolerance. Remember, building wealth takes time and a solid understanding of your investment options. So, grab your notebooks, get ready to take some notes, and let's embark on this journey to financial success together. Individual stock picking, high risk, high reward. Our first strategy is all about individual stock picking. This is the classic approach, where you're essentially becoming your own portfolio manager. You're researching individual companies, analyzing their financials, and deciding which ones you believe are poised for growth. Now, the allure of individual stock picking is the potential for high returns. If you pick a company like Apple or Tesla before they skyrocket, you could see massive gains. However, and this is a big however, it also comes with significant risks. Picking individual stocks requires a lot of time, effort, and knowledge. You need to understand financial statements, market trends, and industry analysis. It's not something you can just jump into without doing your homework. Think of it like this. You wouldn't buy a house without inspecting it thoroughly, right? The same goes for stocks. You need to do your due diligence, understand what you're buying, and be prepared for the possibility that your investment might not pan out. Even seasoned investors can make mistakes when picking individual stocks. Remember, for every Apple or Tesla, there are countless other companies that fail to meet expectations. So, while the potential for high returns is there, it's crucial to approach individual stock picking with caution, especially if you're a beginner. Don't let the fear of missing out cloud your judgment. If you're considering this strategy, start small, invest only what you can afford to lose, and gradually build your knowledge and experience over time. Remember, slow and steady wins the race, and there's no need to rush into anything when it comes to your financial future. Exchange-traded funds, ETFs. Diversification made easy. Next up, we have exchange-traded funds, or ETFs for short. Now, ETFs have gained immense popularity in recent years, and for good reason. They offer a simple and effective way to diversify your portfolio without the hassle of picking individual stocks. Think of an ETF like a basket of stocks. When you buy an ETF, you're essentially buying a small piece of all the companies included in that fund. This instant diversification is a huge advantage, especially for beginners. Instead of putting all your eggs in one basket by investing in a single stock, ETFs allow you to spread your risk across multiple companies, sectors, or even countries. This diversification helps mitigate losses and can lead to more stable returns over time. Another great thing about ETFs is their low fees. Because they're passively managed, meaning they track a specific index or sector, they don't require the same level of active management as mutual funds, which we'll discuss later. This lower cost structure can have a significant impact on your long-term returns, as those fees can eat into your profits over time. ETFs are also incredibly flexible. You can find ETFs that track almost any asset class imaginable, from the S&P 500 to emerging markets to specific sectors like technology or healthcare. This flexibility allows you to tailor your investments to your specific goals and risk tolerance. Whether you're looking for broad market exposure or want to focus on a particular niche, there's likely an ETF out there for you. Overall, ETFs are a fantastic option for both beginner and experienced investors looking for a simple, cost-effective, and diversified way to invest in the stock market. Chapter 3. Mutual funds. Professional management at your fingertips. Now let's move on to mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of assets. Unlike ETFs, mutual funds are actively managed by professional fund managers. These managers use their expertise to select securities and adjust holdings based on market conditions. This active management can be a double-edged sword. You're benefiting from professional knowledge, but it comes at a cost. Mutual funds typically have higher fees than ETFs. The performance of a mutual fund relies on the skill of the fund manager. Mutual funds are priced once per day, unlike ETFs, which trade throughout the day. Consider your investment goals and risk tolerance when choosing between mutual funds and ETFs. Chapter 4. Dividend investing, generating passive income streams. Now let's dive into a strategy that many investors find particularly appealing: dividend investing. This strategy focuses on investing in companies that pay out a portion of their profits to shareholders in the form of dividends. Essentially, you're getting paid to own a piece of a company, which can provide a steady stream of passive income. This passive income can be especially attractive for retirees or those looking to supplement their regular income. However, it's important to remember that not all dividends are created equal. Some companies have a long history of consistently paying and increasing their dividends, while others may have more volatile dividend payments. When choosing dividend stocks, it's crucial to look for companies with a strong track record of profitability and a sustainable dividend payout ratio. This means they're earning enough money to comfortably cover their dividend payments without putting a strain on their finances. Another factor to consider is dividend growth. Ideally, you want to invest in companies that are consistently increasing their dividends over time. This indicates that the company is performing well and is committed to returning value to its shareholders. Dividend investing can be a great way to generate passive income and build wealth over the long term. However, it's essential to do your research, choose your investments carefully, and remember that dividends are not guaranteed. Companies can cut or eliminate their dividends at any time, so it's crucial to diversify your portfolio and not rely solely on dividend income. Chapter 5. Robo-advisors: automated investing for the modern investor. Last but not least, let's talk about robo-advisors. In today's digital age, robo-advisors have emerged as a popular option for investors who prefer a hands-off approach to managing their money. Essentially, robo-advisors are automated investment platforms that use algorithms to build and manage your portfolio based on your financial goals, risk tolerance, and time horizon. Think of it like having a personal financial advisor at your fingertips, but without the hefty fees. Robo-advisors typically charge a small percentage of your assets under management, which is significantly lower than the fees charged by traditional financial advisors. This cost-effectiveness makes robo-advisors an attractive option for investors of all sizes, especially those just starting out who may not have a lot of capital to invest. Another advantage of robo-advisors is their accessibility. You can open an account and start investing with just a few clicks, all from the comfort of your own home. Most robo-advisors also offer user-friendly interfaces and educational resources to help you make informed investment decisions. While robo-advisors may not be suitable for everyone, particularly those who prefer to have more control over their investments, they offer a convenient, cost-effective, and accessible way to invest in the stock market. If you're looking for a hands-off approach to investing and want to take advantage of technology to simplify your financial life, robo-advisors are definitely worth considering. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and hit the notification bell for more investing tips and strategies. Happy investing! Remember, the best way to start investing is to take action. Don't let the fear of the unknown hold you back from building a brighter financial future. Start small, do your research, and remember that investing is a marathon, not a sprint.